you had a great day today. I know that there's a lot going on in the world, and I've actually talked to several of you in the last few, I guess probably last week and a half or so, 2 weeks, and we had some great conversations. So I'm sure that many of you are, I guess, excited, or maybe you're apprehensive about what we're going to talk about tonight, but I told you I would do a much more in-depth update on what we think is happening with the market and the economy, and where I think we are, where the resources we work with think we are, the options that I think are on the table for us, and then the options that you would have to work with as you make decisions also. As always, this financial journey update is about helping you to create, grow, protect, and preserve wealth for your family in today's economy. And today's economy is probably a good word for today. Today's economy is very interesting. We've certainly been here before at times, and just trying to make the best decisions you can is absolutely essential to managing wealth wisely. As always, we have our disclosures that are important for you to consider with everything that we do, whether it has tax implications or legal implications, investment implications, risk tolerance issues, flexibility, access to liquidity or cash reserve, etc. All of the choices you make, you have to do your very best to understand what all of the pluses and minuses are to every program. So far, I've never seen an investment that had all pluses. They all have pluses and minuses, and so we try very hard to help you understand what those are. And once again, tonight we'll do exactly the same. So please, as we're talking tonight, listen and make notes and get ready to make the best decisions that you can as you and I work to go forward wisely. To that point, you make your notes, you write some questions at the end of the presentation. We will also have a time for questions, so you can leave your questions in the chat, or you can raise your hand at the end of the presentation, say that you'd like to ask a question, and I'll be happy to answer it and do my best to give you the information you need. We also have a guest on here, which I'll talk more about here in a few minutes. Vinny Manitola and I had talked about doing this long before the whole Ukraine-Russia thing happened. So I thought about whether to bring him on here tonight, not because I didn't think it would fit. Matter of fact, I thought it would fit perfectly well. I just didn't want to imply that this is your solution. It's not. Vinny and I've talked just even before this meeting tonight that what he brings to the table with Lincoln is a great solution, but depending upon your needs, may be other solutions as well. So when we get to that point where there's questions at the end, you can certainly ask questions of myself or Vinny if there's anything particularly you want to know from what he's going to share. Tonight, we're going to take a look at a more in-depth view of the fundamental analysis for the economy, take a look more at the market and the technical analysis that we're looking at this point, as well as potential entry and exit strategies. As I mentioned a moment ago, Vinny Manitola from Lincoln Financial Group is going to talk about how to protect and grow strategies for volatile markets. I was saying protect and grow long before Vinny did, so I think Lincoln might have taken that from me, but I give them rights to use it, so it's totally fine. We'll also take a moment to look at our 8 asset groups, as well as the 10 investment concepts, diversification in your portfolio management, and why that's so critical, especially in times like this. Remind you of the wealth management apps that we provide for you that can help you manage more wisely. Take a look at your questions, and we'll update for the next webinar, so you have that on your calendar. Last webinar update in February, I spent a fair amount of time going through fundamental and technical analysis, but I thought it was worth taking a moment to talk about it again tonight. That fundamental analysis, I'm going to change this so I got the little laser pointer. There we go. Fundamental analysis is really being able to make decisions to decide, should I invest in a market, an index, or a security? Taking a look at the security or the index or the market's intrinsic value and examining the economic and financial factors. Again, fundamental analysis is really just the study of security or a market or an index to determine, would I invest in it? As compared with technical analysis, which has much more to do with charting, which is really more about, would I invest in that security, index, or market today? And what we'll do tonight is talk a little bit about both, a little more energy into fundamental analysis, at least as much as we can with what we know, and then also spend a little more time on technical analysis to help put some perspective into what you're seeing and hearing and thinking. So let's talk about two pieces that I think probably most of you have heard the terms before and you're aware of them, but I don't know that you really think about them a whole lot. I think about them a lot, to be honest with you, which is the difference between a correction and a bear market. And that's really important because when we are inundated with huge amounts of information, just from all different quadrants, like conflict between two countries, inflation, pandemics, policies under governmental leaderships that we find not acceptable or we don't like them, all those things can take over and can start to color our opinion onto a particular model and say, this is the problem. But if we want to actually take a look at things in light of where they really are, not what we are afraid they're going to go to, not what could happen, but just where we are right now, a correction is usually defined as a decline of 10% or more in the price of security from its most recent peak. Corrections can happen to individual assets like a stock or a bond, or they can happen to an index measuring a group of assets. An asset, index, or market may fall into a correction briefly or for sustained periods, days, weeks, months, or even longer. However, the average market correction is pretty short-lived, lasts anywhere between 3 and 4 months. Investors, traders, and analysts use charting methods to predict and track corrections, and many factors can trigger a correction, and the reasons behind a correction are as many and as varied as the stocks, indexes, and markets they affect. What I would remind you on this sentence here, investors, traders, and analysts use charting methods to predict and track corrections. I would remind you, as I've said multiple times, that if anybody had this figured out, there'd just be one investment company in the world. They'd have all the answers, we'd all invest with them, and that'd be the end of it. But nobody has this figured out. Sometimes people are looking at information, making decisions, and trying to figure out with this information, what does this mean, or what could this imply for the future? But when we're looking at charts and when we're trying to analyze, when traders and investors are making decisions, all of us, including the biggest names that you can think of, the Fidelities, the Vanguards, it doesn't matter. They're all trying to make the best decisions out of the information they have, and they develop disciplines and strategies to help make the best out of market volatility, ups and downs, and so on. The reason I point out about a correction is simply this. A correction is usually defined as a decline of 10% or more in the price of a security or an index or the market. I want to come back to that in a second. As compared to a bear market is a prolonged, typically several months or more of price decline. It typically describes a condition in which the securities or the index or the market prices fall 20% or more from the recent highs, and it happens during widespread pessimism and negative investor sentiment. Bear markets can often accompany general economic downturns, such as recessions. That last sentence there is probably one of the biggest things I've said to many of you over time, is that part of what we're watching for are the likelihood of recessions, which I'm going to spend a little more energy on tonight. I would also point out that widespread pessimism and negative investor sentiment, those feelings can totally take over the narrative. They can take over the meta narrative in our mind and cause us to make decisions that aren't the best choice. So having a good discipline and a good process and strategy for how you go forward is critical for all of us, including me. And so as we make decisions, we try very much to identify where we really are, what's really happening, and then make the best decisions with that information and try to incorporate concerns or thoughts or pessimisms or negative sentiments in it, because it needs to be considered, but it should never be the tail that's wagging the dog. So correction is 10% or more downturn, and bear market is 20% or more and a prolonged time frame. Having said that, so as of year-to-date performance, the Dow is off 7.69%, The S&P 500 is off 10.28, and the NASDAQ is off 17.53. And as somebody who follows these, I can tell you there have been times when the Dow was off more than 10%, and there's times when the NASDAQ has been off more than 20%. But as of today, the close of the market, we're off less than 10% here, right at 10% here, and short of 20% here. Now, with the two definitions I just gave you, you might be saying to yourself, so Frank, does that mean we're close to a bear market for NASDAQ? Well, it's possible, and I can tell you it was more than 20% at one point, but it's that prolonged experience. It's the ability for it to stay down for a much longer time, typically anywhere from 18 to 36 months. And it typically tends to be shorter than that, like the 18-month mark or so. Matter of fact, the correction or bear market that we experienced because of a GDP drop during the pandemic was only 90 days. And then I'm going to show you some things a little bit further that will kind of help to express that. But from my viewpoint, what we're seeing here at this point is volatility. Volatility in the Dow and the S&P, and the NASDAQ has taken it harder because, quite honestly, it had grown more. And so its reaction had more to do with the fact that it was so high that the people were pulling money off the table, people were trying to figure out what to do with various things, and it took a bigger hit. Could there be more to it than that? Absolutely. There's a lot of factors to watch with all three of these indexes, these markets. But having said that, I think that there is this sort of sentiment among some investors that, oh my goodness, we're already in a bear market, and we're not. Doesn't mean that it's not going to happen. It just means we're not there yet. Now, how do we take this information and make use of it as we go forward, trying to identify entry and exit strategies, as I've talked with you before about? So let's talk about those 2 points, volatility and recession. Volatility is a metric that measures the magnitude of the change in prices in a security. Generally speaking, the higher volatility and therefore the risk, the greater the reward. So if volatility is low, the premium is low as well, meaning the potential for gain. Before making trade, it's generally a good idea to know how a security's price will change, how quickly it will do so. That's one of the reasons we use Riskalyze to help you identify how much volatility or risk tolerance you can handle. The fact that when you have the sort of wild roller coaster, wild mouse kind of experiences we've had over these last few weeks, it makes it more difficult to understand that. But that's volatility. It's this up and down, this change, this reaction that may or may not be real. It could be that change was due to program trading, where certain metrics were hit and then computer programs took over and started trading. It could be because investors made decisions and decided to make changes, etc. But I would also say to you, like I've said many times before, that in my view, the markets are really sort of a war between buyers and sellers. When buyers think there's opportunity, they push it up, and when sellers think there's problems and something catastrophic could happen, they push it down by selling. And I think the reality is that volatility we see on a daily basis, especially in times of uncertainty, when stability doesn't seem as comfortable, those things can make people react and swing wildly one way or the other. Nobody likes it. It's terrible. It can cause problems, but it's different than recession. Recession is a different animal completely. It can create and exacerbate volatility, no doubt about it, but volatility typically tends to be short-lived over the scheme of things. Recession, though, while it can be shorter, typically is that thing that actually causes the market to react more seriously and more long-term, because it's a belief that the companies that are in the market or their index, the underlying securities to the Dow or the S&P or the NASDAQ, it's believed they're not going to make money, and so we should take our money out until, or adjust it to other securities that may make money during a recession time. And that can then create that volatility, but it's the recession and trying to actually protect and lock in either gains or not lose anymore that can lead that issue, decision to make those changes. So what's a recession? A recession is a term that refers to a significant decline in general economic activity. it has been typically recognized as 2 consecutive quarters of economic decline. However, the GDP in conjunction with monthly indicators such as rise in unemployment and other factors can impact that differently. So the National Bureau of Economic Research came out, and since they actually declare recessions, they decided to kind of adjust it a bit. So now when they talk about recessions, 2 consecutive quarters of decline in the GDP are not necessarily the definition anymore. They define it as a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So instead of just going, oh, 2 quarters, we're in a recession, now they're looking at it. I think this is probably a much better measurement: real GDP, real income, unemployment or employment, as they say here, but unemployment, industrial production, and wholesale retail sales. So recession is implying that there are serious economic defects or challenges that we're facing that are going to impact the profitability of various companies out there in the various indexes and markets that we invest in. That, which could also create volatility, is a much more, in my thinking, a much more serious concern than just markets changing up and down. The markets changing up and down create that negative sentiment, they create that pessimism, and they may actually, in some cases, lead to some of this with recession, but it's not necessarily that they connect with each other. I'm watching volatility, not liking it any more than you do, but this is what I'm really keeping my eye on. So having said that, we can, with a number of websites, this particular one, pull up from Macro Trends, identifies the Dow Jones Industrial Average, going back, this is actually back to 1915, just 1 year after World War I started. And then we can see how the market has downturned during times like the Great Depression. We can see other times when the market turns down that has nothing to do with recession. That goes back to volatility again. We can see times when recessions happen, but the market still continued to move up. We call those cyclical bull markets. We can see various times like this here where we have pullbacks during recessions and they come and go. This is spread out over a number of years. Flat times like in the 70s where we went for a prolonged period of time of volatility and not really any growth, and we had recessions during those times. More recently, for most of us, Y2K/9/11 really caused us to understand how markets, and this it's sort of a real life experience for any of us who lived through it. The Great Recession, 2008 up to 2009, and then this little tiny line right here you can barely see is the pandemic. That was that recession, which lasted for a quarter, and then the market took off again. Now, what I want to do though is I want to actually use a moment here to show you. No, let's go back for a second. There we go. To take a look at that chart and make it so that it really is a little more realistic. So going back to what we were talking about a moment ago, the Great Recession. There's the Great Recession period. So we're looking here, this is August, and then September. So see, this is August 2006. Here we are, February, March 2007, May, June, move up into here, here's September. And I can remember in September and October watching the news, trying to get an understanding of what was happening, and hearing President Bush at that time come on TV and say, look, you know, America is great, it's strong, it's going to keep going, just keep consuming, keep buying like you always bought, companies will stay strong and be fine. And people tried to do that for a while, but pretty soon some of the other issues that were out there, primarily with bonds and mortgages that were mishandled and such, it started to take its toll on the markets and the economy, and there was much greater economic angst and reality for that when it came to real income, real GDP growth, when it came to employment or unemployment, industrial production, also looking at wholesale and retail sales. We saw that the market fell, and we see how the recession worked through that process. And here we are in 2009, the market, the Dow in this case, bottoms out. The recession is still going on, but you'll notice the market started to take off again. And see, again, that speaks to the fact that there comes this place when the markets fall far enough down that the buyers say, this is silly. There's more opportunity here. And they use that as a time to buy. And then they begin investing in the markets. Typically, the more risk-oriented are the first ones to enter. And then as they do, it starts to create more of a sense of positive sentiment. And so then as we go through it, we come out of the recession and the market takes off again. And we can see that during that period of time, the markets can do much better then, and they will do better then. So we're looking at a recession here from, this is what, December 2007 to May of 2009. And, you know, typically we think of the Great Recession as being a pretty awful time, and it was, but I'd like to point out it really was right around that 18-month mark. So again, corrections, volatility, recessions, bear market. We need to be looking at what's going on here with facts and common sense and make good decisions. And when I say that to you, I'm really pointing back at me with 3 fingers, because as I'm trying to help answer questions for you and I'm trying to determine how we're going to manage portfolios and make things work, I have to watch I have to check my emotions and make sure that I don't make silly decisions as well. So we're watching just like you're watching. So when you look at something like the Great Recession and you see this and you think about the current downturns in the market right now, 7.69 on the Dow, just at 10 for the S&P 500, and approaching 20 for the NASDAQ, you have to recognize that we've got a very short time frame here. The real question that each of us has to really actually figure out has to do with, is this going to generate another recession? And to my way of thinking, that's really what my bigger focus is on. Can the volatility turn and the market go back up? Well, we saw that today. I'm not saying that's the end of it. We're done. It's not, clearly. But can it do it? Yeah, it can. It can take off again. And sometimes people get out too soon and miss opportunities. And our goal, as I've told you many times, is to be proactive wherever possible and reactive whenever necessary. And so making a decision to jump out right now is, as I'm going to show you in a little bit here, not what my primary thinking is, but I can assure you that when we get enough data that makes me think we got a bigger problem, I would be ready to do that. Now, if I'm sitting with you at your house right now, one of the things I would be saying is, okay, great, how do you make that decision? What causes you to do that? So what I want to do is show you how we processed information during the Great Recession so that you can understand what we're going to do here. Not that I'm thinking history is going to repeat itself, but I do think it could rhyme a little bit. And so I want to be aware of it and make good decisions in that process. So let me go back now to our presentation. I know some of you are making notes right now, and you're going to be hammering me on questions, so I'm getting ready. All right, so what you're looking at here, down here at the bottom, you can see this is 2008. I want to turn on that laser pointer again. In 2008, so here's 2007. This is what I was just showing you a moment ago. Here we are, and this is July, August. Market kind of did a little bit of a drop, went up here, September, October. I mentioned before, I can remember President Bush on the TV. Now, I don't know if you remember it, but this is October of 2007. We just had an amazing run up from 2002 to this point in time, and we kind of get our mind in this place where it can never go down. And so when this little bit happened right here, you'll notice that the green bars identified this peak to this peak, and this peak was higher. Now, in a chartist viewpoint or with technical analysis, that's a positive piece of information. Even quite honestly, looking at this downturn and then seeing how it came back up, looking at the 50-day moving average and the 200-day moving average, looking how the daily activity broke through the 200, came back and took off again. At this point, I, like anybody who studies this, is thinking, oh, okay, it's all right, it's gonna be okay. But still, the news is not comfortable. There's some weird news out here, and we can't quite get our head around what it is. So then after October, go to November, the market drops. We now find that the 50-day moving average in December breaks through the 200-day moving average. We see that the daily activity broke below the 200-day moving average. It was almost a straight line, but it still broke below. This is where, again, that war, sellers, buyers, comes up, breaks above the 200-day moving average, and then goes south. And quite honestly, at that point, it takes a big tumble. Now, as you'll see in the next slide, it's not the biggest tumble, but it's a big tumble. And so looking at it from a technical viewpoint, you identify that the tops are getting lower, you identify that the bottoms are getting lower, but then you'll notice here, these two bottoms, they didn't go lower. As a matter of fact, what happened was they turned up. So now by this point in time, this is May of 2008. Now on this little chart, we see recession in here, but the problem is we weren't really sure we're in recession. That's the whole thing about recession, is they tell you after the fact that recession has happened. They say, oh, so we've had the 90 days of negative GDP growth. Okay, so now we did have a recession, but you don't really know that, much like we don't really know what it is right now. Or they tell you about the real income or the real unemployment or GDP growth. They tell you these facts, but we don't really actually know yet. None of us do. I mean, we're trying to, I can tell you I am, searching data the whole time to try to figure out if we're near that. Certainly there's reason to think we could be, but are we? So by this point in time, this is October of 2007. During this time, for many of you who are with me at that time, you know that I was telling you we're holding, but that I'm watching carefully. And when we got to this place right here, and the daily activity ran up into the 200-day moving average, remember, it's below the 200-day moving average this whole time. The 50-day moving average is also below. It breaks up, it comes up here. This is called convergence divergence. It hits it and turns south. And it was this point here that we sold out of most of our aggressive positions. We had pulled a little money off the table back in here, but this is when we made all of our big changes. Now, if you look at from here to here, we lost money. I wish I had known here, but I'm not God. I don't know how things are going to go. And so we held. But when this happened, this was the final straw that made me say, okay, this is going to get worse. We got a lot of really weird data, and we're going to go ahead and get out. And we did. And so whereas the next slide, which was, this is where we just were, the next slide went way down. We were down about less than 15% on our most aggressive accounts. I'm not saying that we can do that again. I have no idea whether we can or not, but I'm telling you that the same discipline I used then is exactly what we're doing now. We're watching the data, we're watching fundamental and technical analysis to try to make decisions on when and if we should get, or maybe I say if and when we should get out. And so we are so new into this with correction and everything right now, it's not possible to say with certainty we should get out. Now, what I would say is that this, again, this is 2008, here's 2009. You may remember that the market bottomed out in March of 2009, and then from there it started going back up again. And we had this terrible, long, uncomfortable experience that many people were terrified of. Having said that, we got out back up in here, not because I'm brilliant. Honestly, it was just me making a decision, which quite honestly could have just as been wrong, because it might not have gone down. That's why we try not to get out too soon, but we also try to make decisions. And I don't tell you that to say, oh, you can trust me. I tell you that to say, this is how we're functioning. This is what I do. This is what our team does as we are making these decisions. The changeover from roughly 1,400 and as the S&P, so 1,450 or so down to 700 means you were looking at about a 50% loss. If you had stayed in from up to here to down here, and then started working its way back up. My opinion, as I told many of you, is if we can get out sooner, it means we have more money to invest when we make a decision to get back in, which is what we started doing in 2009 and 2010 and 2011. So the fact is, this isn't a perfect system. There are many people that are way smarter than me that could call this better than I did, but I'm telling you, this is how we make these decisions, and there's nothing changed on that. We're still going to keep making these decisions as we try to figure out when to get out, if we need to get out, and what's the best way to get out. So now I know we're going to have some questions on that. So taking this data, which is back in 2008 and 2009, let's move it forward to today. So I'm going to again go ahead and go back to this chart. So this chart here we're looking at is our most current time, 2022, down here. Here is January of 2022. So we had a very nice run up. It's been wonderful, but now we start to have some problems associated quite a bit, honestly, with inflation, concerns about rising oil costs, the inability to buy things, the concerns about employment for small businesses and companies to be able to get workers. There were a lot of things that were happening, and so the market was like, oh, this is not comfortable. So we move into February, and then we move into Russia deciding that a dictator named Vladimir Putin, who feels like he has the total authority to take over another country because he just has a desire to, think that people who think that dictators and progressives really don't have some thinking they have to work on, they really should watch this, because we're watching a man decide that he has every right in the world to take over a country. And it's because he has authority, and he's got people around him who, like nations, NATO and America, who are afraid, who are trying not to get into this conflict. So he's getting to do what he wants to do. And it seems like, other than the Ukrainian people and a few supporters around Ukraine, I know we're sending a few things there, but this nation is really on its own. Ukraine is doing an amazing job, but I know that I wouldn't want to be in that situation. I know if that was happening here in America right now, that would be a terrible experience. And part of the reason I'm saying this right now is that there's a part of me even feels a little bit bad about talking about finances when these people's lives are being upended and ruined, maybe for generations to come. But the bottom line is that my job is to help you do this. And so as we look at what's happening here in the markets, we see the markets going down. If I were to draw my lines again, we'd see the low are getting lower, the highs are getting lower. We do see a little bit of a consolidation here, a support floor. That makes me wonder what that's going to look like. We're looking at a lot of different factors, things like inflation and oil prices and many other factors to help us decide, looking at something called the VIX, which I've shared with you before. The VIX is sort of the opposite to the market, looking at various pieces. But what I would say to you is this is new. This is just a few months into this. And I'm not even quite sure what this would have looked like had Russia not invaded Ukraine. I don't know that we'd be looking at exactly the same behavior here, which means that the markets and the economy in the US might not be as bad as we think. And I know for some of you, I know you're like, oh no, it's horrible, it's terrible. And I get why you say it, but when I'm looking at the ability to transact commerce, and I'm looking at the options and the fact that the roads are still full and people are still buying things and doing things here in America, I think that it's easy for me to take my concerns about policies, administration policies, and then extrapolate those into the distant future and then move them back here to now and say, okay, it's time to make this decision, which we could, but I'm not so sure that's the best answer. So I point out to you that we're looking at correction, not recession yet. And with more data over the next weeks and months, we'll be able to know if we're looking at recession. And if we do, this will be a very similar process. We'll be watching. Notice here, this is the 50-day moving average. It just has now broken through the 200-day moving average. We can see the daily activity has dropped below it. There's a pretty big spread there. We can see by activity volume, more sells than buys at this point, because the sellers are sort of running the market. But at some point, we might find the buyers take over again, or at some point we might find recession kicks in which case the market could react more negatively. So my point today is not to say, oh, there's nothing wrong, don't worry about it, we're buy and hold, it'll be great. My point is to say that there's just not enough fundamental analysis to make technical decisions to do anything with, at least with any high level of confidence. That doesn't mean you couldn't do it. It just means that my position right now is I want to give it a little more time to watch through this. And if we have to start doing an investor update every 2 weeks or every week like I did during the pandemic to keep you updated, we'll do that. But for now, I feel like the technical analysis doesn't support making this big change yet, and maybe another week or maybe another 30 days it will. But for right now, we're of a mind that there's a downturn and there'll likely be some sort of a rebound as the buyers decide there's more opportunity here. Now let me go back and finish up what I want to hit on here for today. So there we go. Okay. So now, what are the fundamental analytics we're watching? So the unresolved supply chain issues from the pandemic. I know the pandemic's over. I've heard the media and the administration talking about it. And I'm comfortable with that, to be honest with you. It doesn't bother me a bit. But we just heard the transportation secretary talking today about how, you know, there's supply chain issues and like it's hard to get oil because it's sitting on boats right now still. And there's other issues that haven't gone away yet. So those issues are being resolved, but they're not done yet. And supply and demand forces prices up. Even if it's just temporary, it forces prices up. But once everything is a little more stable and normalized, competition will force those prices back down again. How much? That's another conversation. The current energy policy for the Biden administration seems to be problematic. If you look at the data, I know that some are saying, oh, this is because of Putin. Certainly, you know, there's some piece of that. I'm not saying he doesn't have any piece in it. He does. But this was happening before that happened. All you got to do is go look at the data from when he won the election or when he took over on January 20th to where gas prices are today. It was happening the whole time. And Putin and any of his work was just happening here only more recently. So the energy policy that the Biden administration is doing is having an impact on that, which then brings us to inflation. Since oil goes into everything, we've got a part of it that's transitory, meaning that it's going to disappear as supply chain issues are resolved, but a fair amount of it's going to be permanent. Some of the prices that we're paying now, they may go down because of competition, but it's going to be up there a ways. The FOMC meetings where the Federal Reserve is going to come out and talk about what they think regarding interest rates. They were totally planning to raise interest rates off this meeting from this will be tomorrow, the 16th is when they'll come out and talk about it. They may, or they may decide that what's going on right now, if they were to raise them, it could create recession. Market went up today. I think the market is anticipating there'll be a rate hike. Again, markets are funny. If there is a rate hike and the market hasn't perceived it's going to happen, or they thought it might disappear, market could go down. On the other hand, if they do the rate hike, the market could see that as a good thing and go higher. Again, we'll have to wait till tomorrow, but that won't be the end of it, because May 3rd and 4th there'll be another one, and June, not June 114th, June 14th and 15th there will be another FOMC meeting where they'll talk about rates again. I think there's a lot of pressure for that not to happen because the election's coming up and there's concern that rate hikes could create inflation or a recession. But again, there could be this need that everybody realizes we have to slow things down to make it so that inflation doesn't keep running up like it is, which interest rates rising could do that, but rising interest rates with inflation still there could impact recession. So number 5, potential domestic economic weakness and or recession, which is kind of what I've been looking at here and addressing this whole time. Certainly the Russia-Ukraine war is having an impact on this, and then there could be offshoots from other things. Maybe China and Taiwan could be another issue, which I think would really be very problematic, which brings me to expanded geopolitical concerns like potential international conflicts, as well as geopolitical concerns regarding economic weakness and recession. So, you know, other countries could have recession, which could slow things down, or Russia, because of their economic woes, might not be able to pay their interest to other countries they borrowed money from, which could slow things down. There's a number of pieces that are at stake right now, and so we don't know, you know, whether there is no more additional conflict, but there is economic weakness that could have some problems. So with that in mind, what are the options? Well, First option is we could utilize assets or securities that are called negative correlators to the overall equities market, meaning we could choose some assets that do better in recessionary times as a way to offset the downturn in the market. We could implement that, which we have been doing in many of the portfolios with energy and some other components as well. But as we move further down the road, we might have to adjust that. As I've been saying in previous months, that we might make some adjustments here, and depending upon recession and what that really, not recession, but inflation and what that looks like, those could be more issues. Number two, we could adjust the portfolios to more conservative positions immediately to protect against further portfolio erosion, meaning some of you have commented to me, our portfolio is down a little bit, and we could make changes right now to stop that. And as I've said to you before, you're the boss, I'm the employee. And so if you said to me, Frank, I just can't take it, I want to get more conservative, be happy to do that. If you said, I want more negative correlators, be happy to do that. We'll do that for you. What I'm doing, as I just said a moment ago, is I'm continuing to review the fundamental and technical analysis, and we'll adjust portfolios to more conservative positions if and when the fundamental and technical data supports that adjustment. As you saw back in 2008, market went down, came back up. Once we saw some other technical data that went with the fundamental, that's when we pulled the trigger. As I've shared with you many times, it's impossible to hit the peak. I'd love to be able to hit the peak every time. And if I knew somebody could hit the peak every time, that's who I'd work with. But nobody can hit the peak. You're aiming at early downturn. And so that's what we do. We make a decision with the fundamental and technical analysis on when we're going to pull back if we do. And again, I love to be proactive wherever we can be, but reactive when we have to be to create, grow, protect, and preserve wealth. Now, as I mentioned before, long before this meeting, Vinny and I talked about having come on and talk about Lincoln. One, because several of you have their programs, and two, because I think it's a great program to make it so people can get in the markets and have a greater sense of calm and stability, and they can stay in it longer when we go through times like this. Vinny Manitola, you're on here now, right? Vinny?
I am. How are you?
Great. I am good. Say hi to the audience. Let me make you presenter so you can share some things. Vinny and I have known each other for a long time. I've had the pleasure of driving his Tesla Model X, which I love and want to get one of these days, although I'm probably aiming for the Cybertruck. You're aiming for the Cybertruck too, right?
I was. Maybe the Cybertruck keeps getting pushed out there further and further. I think Elon is a little bit more concerned with his potential fist fight with Putin that he keeps talking about.
Yeah, you're right. Here, I'm making you the presenter.
Perfect. Thank you.
If you would, I know I've ran a bit longer. I told you I might, but I want you to have some time to kind of share what you think the Lincoln product could do, because it certainly is one of those solutions that could help our clients if they want to stay invest in the market, but they're concerned about things. It's certainly one of those. It's not a negative correlator, but it certainly has some benefits that could do that. So I'm going to stop talking and let you share, Vinny.
Wonderful. Well, I appreciate everybody kind of having me on today. And Frank, I was listening and actually taking some pretty good notes about what you were talking about. And the thing about market volatility is that it never feels good to see dollars and cents movements. And we can talk about them in percentages. And that's how we kind of try to bring the emotion down a little bit, percentages versus dollars and cents. But whether it's $1,000, $10,000, $100,000, seeing that dollar amount change it has a major effect on us. And so what we try to do as financial professionals, and Frank, I'm trying to get this content to load here as we're talking. It seems like it's not letting me share my screen. It wants me to share a document. So I'll have to reload that stuff here. It's okay. I might be able to get this downloaded as I'm trying to talk through this.
Okay.
But one moment.
Technology is awesome until it's not.
Yeah, I've got it downloaded. It's I was trying to just do a straight screen share, but it's only giving me file, whiteboard, and website. So I may just have to kind of talk through this. So when you think about market history, right, the common theme or the four most dangerous words that we've heard is this time it's different. And in fact, they don't even say that anymore. Now they say the new normal because they know they're not allowed to say this time it's different. But as Frank was showing you that, the past doesn't necessarily predict the future, but typically it rhymes. And what we wanted to share today, which unfortunately is not going to come up here on the screen, what we wanted to share today is a little market history. Because if you date back, what we did is look to 1970 to today, well, really through the end of 2021. And we were looking at 6-year increments in the market. And there were 529 possible 6-year increments that have, and forgive me, I write like a child. Normally this is on print. There are 529 6-year increments that have happened in the market over that period. And the reason why we're looking at 6-year increments is typically when people invest in the stock market, looking at a longer time horizon. We're not necessarily looking to only invest for 3 months, 6 months, a year. We're trying to get a longer time frame invested. And the first thing that shouldn't be a surprise is more often than not, about 85% of the time, that 6-year period is positive, and the percentage is gone now. So
I'm giving it back to you.
Okay, cool.
See if that helps.
Still not letting me share the screen.
All right.
But yeah, I don't know if maybe you make me the host. Is that a
Let me try
way
it.
to do it?
Maybe it is. Let me try it.
Sorry, folks.
Connected to audio. Let me just check one other thing. Maybe I do know. Maybe there's one other problem here. Just seeing. Go ahead and keep talking. Let me look for something. I might even be able to pull up your presentation so I could show it. So go ahead, keep going though.
Okay. Actually, I might be able to pull up an older one. So let's work off this one. Okay. Hey, here we go. Where was I? We were talking a little bit about market history. Okay, so this is actually the first slide I wanted to show. And this looks similar to what Frank had on the screen a little bit ago, right? You see a lot of markets ups and market downs, and our job as financial professionals is to help modify behavior. Because if you were to draw a straight line, the market has gone straight up for the last 25 years. The problem is we can't just draw a straight line. We have to see market ups and market downs. And in reality, if we were able to just close our eyes and take emotion out of investing, that is a straight up line. What we want to try to do is to take the emotions out of investing. And that's where I was referring to with percentages versus dollars and cents. And what Frank is kind of alluding to, that there's a difference between corrections and recessions and market-driven events. There's even two different kinds of recessions. There's catalyst-driven recessions or economic recessions. What we want to try to do is keep people invested over the long period of time. And so that data that I was referring to is if you go back over the last 529 6-year periods, right? 529 6-year periods. Oh, we definitely want to erase that. 465 of them were positive. That's roughly 85% of the time. So when you look at the market over a 6-year period, about 85% of the time you end up with a positive result. Now, that means there's 64 times you ended up with a negative result, but we wanted to take those and look into subcategories to see when the market actually has an extended negative period, what that looked like. And so if you look at the bottom part of this chart, let's get this erased here. If you look at the bottom part of this chart, we see that, there we go. Of the 64 times, 42 of them were down. I'm sorry?
Are you sharing something?
Yeah, can you not see the screen?
I cannot see it. I wondered if it was just me, but I just had somebody else say they can't see it either.
Oh boy.
Let's see. Hang on a second here. Yeah, see, it doesn't, it says waiting to view your screen. Have you shared it yet?
Yeah. Well, I guess we'll just talk through it.
Okay, I'm gonna pull your presentation up. So go ahead.
Okay. So if you can pull up the client guide, I'm looking at that market history piece. But we were looking at the point of this is when the market does go down, typically those losses are somewhat muted. So 42 out of the 64 losses were down between 1 and 10%. The remaining or additional 22 of them were down more than 10. 6 of them were down more than 15, but there was not a single time over a 6-year period that the S&P 500 was down more than 20%. Now, again, let me back up a little bit. That doesn't mean that there's not a 1-year period or even a 6-month period that the S&P 500 can be down more than 20%. But the point is, if you stay invested for a longer period of time, gains happen significantly more often than losses. And when those losses do happen, they're typically somewhat muted, right? With the worst loss ever being about 18% over a 6-year period. Well, that's where Lincoln and some of the things that we can do come in, because we have investment options that have the ability to absorb a portion of the losses. And many of you on the call may actually have this. It's called the buffered annuity or Lincoln level advantage, where Lincoln will actually absorb 10, 15, or 20% of the losses that happen in a contract over a 6-year period. So the point of these products are to keep you invested through these short-term corrections, right? These corrections, we want to try to figure out are they short-term drawdowns? Are they catalyst driven? Is it a Russia-Ukraine thing? Or are we in a true economic slowdown, a true economic recession like we saw in 08, 09? Well, if we have these buffers or these shock absorbers, if you will, to take a little bit of the sting off of those initial corrections, you can end up being in a position where we can stay invested through the short-term volatility and achieve the overwhelming gains that happen more often than not. Right? 85% of the time you end up with a positive return, with that average return being 68% over a 6-year period. Frank, any luck putting that on there? Or can we still not see the screen at all? There we go. All right, we'll talk you through it. So Frank, we're gonna look at page 2 if you can. Page 2, left-hand side.
All right, here we go.
Page 2, left-hand side.
All right, there you go.
See, didn't make the numbers up. So exactly as we were talking about, left-hand side, looking at the S&P 500, going back over the last 50 years, 529 possible 6-year periods, right? 87% of the time, almost 88% of the time, you end up with a positive return. There were 64 times you ended up with a negative return. And when we broke those down into subcategories, we're looking at the lower box, losses within 10%. 42 of them happened 0 to 10%. An additional 22 were more than 10. 6 of them were more than 15, but not a single time was the S&P 500 down more than 20% over a 6-year period. So again, the point of that is when we do see drawdowns over a longer period of time, they tend to be somewhat muted. And that's where these buffered strategies that can help absorb a portion of the losses can keep people invested through the downside. And I think the most surprising thing is when Frank just went through this amazing presentation showing that the enormous drawdown of 08 and 09, but the worst 6-year period for the S&P 500 in the last 50 years was not 08 or 09. It was actually a period of time where we had true inflation and true rising interest rates. And I'm not trying to say $5 a gallon gas is not inflation. It is inflation. We are seeing inflation in the United States today, but nothing compared to what we saw in the 70s, where we had true inflation and true rising interest rates. In fact, it was actually stagflation because we were in a recession in high interest rate and a high inflationary period. And the 6 years ending November of 1978, the S&P 500 was down 18.8% over that 6-year period. So again, with a 20% level of protection, all those losses would have been completely avoided inside of some of these strategies that are available. And that was a real aggressive interest rate and a real aggressive inflationary period. So the past doesn't predict the future. We can't say this time it's different because there's a lot of similarities to what's going on with stuff we've seen in the past today. But also, presidential policy doesn't necessarily directly affect economic output. There are some things that definitely will be affected, but we've seen corporate profits at all-time high. In fact, 2 consecutive quarters, the third quarter of 2021 and the fourth quarter of 2021, were back-to-back periods where you saw 75% of the companies in the S&P 500 beat expectations, not met expectations, actually beat expectations over that time frame. So we're seeing corporate profits still be very, very strong. We do think that over the longer period of time, there is an opportunity for equity markets to continue to perform, but where Lincoln can come in and help is by absorbing a portion of the downside that happened in a contract. We can allow you to stay invested through that potential recovery. Frank, if you don't mind flipping over to, you had the market history and the client guide.
That's not this piece, right? Or is it?
No. The client guide.
All right. Go ahead. Go ahead and talk a little bit here. I'm going to go find it. I'll be right back.
Well, because visually what I wanted to kind of show is what that looks like, right? So if you think about part of the story that Frank was really alluding to is protecting against losses allow you to have more money to have invested in the recovery. Well, if you do have a negative 6-year period that actually occurs and Lincoln absorbed 10, 15, or 20% of the losses, typically following a negative market is a positive market. And that is kind of a standing behind you, giving you a little bit of a shove, a little bit of a oomph into the ensuing recovery. So that's also how these products can help modify behavior, because if you do have a period of time where you had a negative market, it's exactly it. I think we're going to go to about page 5 or 6, if there's a chart. If you do have a period of time where you have a negative market, you want to make sure that you have money invested for the recovery. There you are. Oop, one more. Nope, one more, sorry.
No worries.
There you are. So here's kind of a scenario where you had, market performance that was really good, but you really want to look at scenario 3 and scenario 4, right? So let's say you had in scenario 3 an index net, and you can actually see that on the chart if you go down a little bit, Frank. In scenario 3, the S&P 500 performed at a negative 10%, right? So if you had $100,000 invested, you would have had only $90,000 for the ensuing recovery. But with that level of protection, you had $100,000 that was available to be invested for the recovery. And again, down markets are followed by up markets. Even in scenario 4, where we had a significant drawdown, something that's never happened before, down 25% over a 6-year period. Instead of having $75,000 to invest in the ensuing recovery, you had $95,000 to invest in the ensuing recovery. So protecting against losses gives you a head start for the recovery that follows. So these products can do 2 things: keep you invested for the potential up markets, and also keep you having a higher value to invest in the recovery. And I kind of will summarize these in kind of 3 points. Again, it's been a little jumbled, but I think if you remember nothing else from what I talked about, it's 3 things. The 3 things that no one wants to have happen when they invest is, number 1, you don't want to lose money. Number 2, you certainly don't want to pay somebody to lose money on your behalf. And number 3, and this is why you work with Frank, you don't want to make a bad choice. And the worst choice that you can make with investing is never getting invested, right? And so if there are options like this Level Advantage product that allows you to, number 1, protect against losses. Number 2, there's actually no fee on this contract. As long as you own it for 6 years, there's no investment charge, no contract charge. There's no fees to own this contract if you own it for 6 years, which is why I keep talking about that kind of 6-year period. But number 3, it allows you to stay invested in the equity markets, which, as you saw from the data, overwhelmingly are positive more often than they're not. And when they are positive, they're positive to the nth degree on average, about a 68% return over that 6-year period. So I'll kind of kick that back to you, Frank, because I want to try to keep people on time. I know there was a lot of technical issues that happened, but it piggybacks really well off of what you were talking about. Is that if we don't know what's happening in the next couple of years, if we're not 100% sure whether we should be in or whether we should be out, and we want to stay invested in case we do see a recovery, if we can shift the risk to an insurance company like Lincoln to help offset a portion of those losses, well, maybe that allows us to stay in and not have to try to figure out what's going to happen here in the near term and stay invested for the longer term.
I agree. And while as I said before, this is not a negative correlator program, meaning it doesn't do something opposite of the market. It allows you to invest at the market or in the various indexes, and it allows you to have protections in place that make it so if things do go south, you have the ability to have money returned to the account if you're staying in there for the 3 years or 6-year model, based on whatever protection you choose for this account. All right, so let's see here. I don't see any questions. If you do, just go ahead and start writing in the chat area what your questions are, and Vinny or myself be happy to go over those. I'm going to go ahead and go back and finish up what I was doing so we can be done on the call here. It's going to be a few minutes late, but I'll make it work. So again, if you have questions, please feel free to ask those, and we will definitely take a moment to go over those. There we go. Okay. So with that in mind, gotta turn my camera on too. Not that you need to see me, but there you go. Okay, so Vinny, thank you for that. And I again, please hang on because I want you available in case people have questions, because with the technical difficulty, I'll tell you, when Vinny's able to show the slides that he is, you really get a great sense of what this product could do for a portion of your portfolio that you want to invest, but you want to have those protections, that both the probability and the surety at the same time. The cyclical nature of investments, we've kind of been addressing that the whole time. As I said to you before, there is always a there it is. There's always a peak and there's a trough, and I wish I could hit the peak, but I don't know anybody who can, including any of you, including Vinny. As smart as Vinny is, I don't think he can hit the peak either. So what we do is we look for the early downturn and we try to make decisions when that's happening, get out of it. It'd be wonderful if we could make it at the late upswing, but again, it's very hard to do, and you just don't know if you get out here or you get out here. I've had clients who they were doing some of the stuff with energy and got out too soon, and I talked to them today and like, I wish I'd held on a little longer. You just make the best choices you can. But again, on the cycle, what we do is we look at trying to get in the early upswing, so we're not having to follow this down, which means we have disciplines and technical analytics we work off of. With that in mind, we have all of the various programs we work with for cash reserve, bond programs, equities, real estate programs, tangibles to offset inflation, currency, using fiat currency, business interests, and what Vinny shared tonight with annuities gives us a tool that can provide stabilities and riders to help us go through difficult times and stay invested. How much should we put into any of these various accounts? It just depends a lot on your risk tolerance, on your need for cash reserve, on income opportunities, what you need for that, on your the amount of assets you have to diversify into things that could offset inflation, and various other pieces that you would do here. So when I put this up, it's really just to remind you that we can make decisions how to create very unique portfolios for you using these 8 different areas to maximize return and control or manage risk simultaneously. Again, one more piece. I know that more of you are using them than ever before, but we have these various applications that we provide for you. You have your wealth management dashboard, which can consolidate all of your financial information, making it available for you to see what you owe, what you own, your income and your outgo, and be able to do it on an updated basis, on a daily basis as well, 24/7, 365. That's your wealth management dashboard. The assets that we manage for you, you have a portfolio management dashboard as well, which includes performance as well as updated information 24/7, 365. because financial planning isn't just about money, it's also about meeting the goals you have in life, your return on life. We have the My Financial Life Plan app that you can use to identify and prioritize your life goals and your life transitions. And then at times like this, it's really good to reassess your risk to make sure that you really are as comfortable with the risk scoring that you've chosen, because it's important for us to match up your portfolio management to your risk scoring, so we can help do that as well. So these 4 are available for you. If you're not using them, please let us know. We'd love to help you use them. All right, I see there's a couple of questions, so I'm going to open up here now on that. All right, looks like there's more than a couple. Let's see here. Okay, so Angela has a question. Make this a little bigger so I can see it. Okay, is there a top cap on the Lincoln product? Vinny, that's going to be for you. Is there a top cap on the Lincoln product?
So that's a great question. So, and I don't know if you want to try to share the rate sheet, but the neat thing about the Level Advantage product is it's customizable to each individual client. So for the level of protection that you find appropriate for you, the trade-off is how high the results can go. So currently, with the 10% protection and a 15% protection, there is no cap on the upside. If we go to the 20% level of protection, there is a performance cap of 100 on the S&P 500 and 150% on another index that we like to talk about with the capital strength index. But if we use a 10% level of protection over a 6-year period, or a 15% level of protection over a 6-year period, or even a 10% protection over a 3-year period, there's no limit to how high the account can grow. And that actually it's quite interesting, because based on volatility, when we start to see these market movements, that's how you see the caps and the buffers change. But do note that whatever the contract terms are when you enter into the contract with Lincoln, it can't change over that 6-year period. So really, really great. Again, 6 years with a 15% level of protection, for example, right now, no limit to how high that contract can grow.
And then also, Angela's asking, what's the minimum investment for this contract?
So the minimum investment is $25,000. What we want to do is, again, figure out, as Frank just had eloquently on the screen, like what percentage would go in which asset class, what strategy, what risk tolerance. It really is what's appropriate for you. We see some clients allocate their fixed income exposure to here and use a higher level of protection, kind of as a bond alternative. We see some clients that are looking to de-risk their portfolio and say, you know what, I'm not really sure what's happened in the stock market, but I don't want to go to bonds or cash. And this is a nice kind of middle point where you can still stay equity exposed, but still have that level of protection.
And I would add to that, because I've talked with many of you about this, is that with interest rates where they are, if interest rates do go up, bonds are not going to be that best place to be, especially if you're using a bond fund or something of that nature. So when Vinny said a moment ago, this particular program could be a bond alternative, that's how some of you are doing that. And so for those of you who are not quite sure about that, we can get Vinny back on the phone and talk about it to give you more understanding of that. All right, let me hit this last piece. Okay, so doesn't look like there's any more questions right now. So sorry that we've gone over. We try really hard to end at 6:30 because I know that you all have plans too. So again, if you have more questions, certainly feel free to email me. You can email info at Frank's office, or you can email Cher, who is the one who sends you the links for it. I'd be happy to take some time to visit with you and answer questions offline. And if we need to for this, we could actually get Vinny on the phone too to help with getting those questions answered. The next investor update, the monthly investor update, you can invite your friends to. I see we had a really large group tonight, and if you have friends who you think could benefit from some of this discussion, April 19th, they are welcome to attend. Just let Cher know so that she can send them a link and they can join in and hear this information and utilize it in whatever way works best for them. And then lastly, as we had gone through this, again, my goal as always, and in an hour, it feels like a long time, but actually it's compressed trying to get everything done. We've talked about fundamental analysis of the economy, technical analysis of the markets, how we're viewing entry and exit strategies potentially for this. Vinny did an amazing job despite all of the technical challenges of talking about how to protect and grow strategies, the protect and grow strategies for volatile markets. And Vinny, might have to have you come back so we can get this set up so you can show it again, but I appreciate all you just did there. The 8 asset groups, the 10 investment concepts, I really didn't get through those this time, but I did get through the 8 asset groups. Diversification of the portfolio, as Vinny pointed out, you don't want to put everything in one basket. We want to diversify in a way that makes sense based on your needs. Again, use those wealth management apps. Those are services that I pay for and provide to you to help you get the most benefit out of what you're doing with us. Questions? I don't see any more right now, so I'm assuming that we've got this thing worked out. And I already just shared with you the next investor update. As always, it is my pleasure and my honor to serve you. I think that while it's fun to work in the good times, I think this is really the time when people really bring me onto they look to me, because they're asking me to be making those decisions, to be identifying opportunities, to be identifying times to make adjustments, to be able to bring new programs to you from an investment or management viewpoint that can help you create, grow, protect, and preserve wealth for your life, for your retirement, and then for your family. So hopefully that you got something that you needed tonight. And if you have any more questions, as always, I am here for you. Our team is here for you, and we'd love to take some time to help you get confident or remain confident in this market and this economy, because this is just one of those moments where things go awry, but this too shall pass as well. Vinny, did you have anything you wanted to add to this?
No, I'm in 100% agreement. I think that everyone who logged into the call today, you've done yourself a favor of staying informed, making sure that you are tuned in, but also know that Frank is working really, really hard behind the scenes to keep track of all this. And hopefully we can do this again, and I'll be able to figure this out. But I appreciate everyone joining, and Frank, your partnership, and just awesome stuff.
Same here, and I feel exactly the same way about you, Vinny. Thank you so much for all you do and how you help. And again, I'll say one more time, thank you to all of you who are on the call tonight. Appreciate you more than you know, and it is my pleasure and my honor to serve you. So at that, I'm going to go ahead and end this. I'm going to get something to eat for dinner, and I will look forward to talking to you soon. Until then, have a great evening, and God bless.